So today we're going to be looking at these key takeaways: how to read the deed, reviewing the key deed definitions, the key roles in an SMSF. Then we can get to the funky stuff: how to lock in succession options, how wealth can be kept in the bloodline, problems with binding death benefit nominations, and why Grant recommends SMSF clients using an SMSF Will. Then Frank LaSpada will come on with 7 massive SMSF problems and how to avoid them. Let's get straight into this. Now, Grant, just so we can set the scene, a lot of in the accounting industry know you, but a lot will have recently heard about you when we've been doing a lot of work together, like your Docs and Change GPS. For those that don't know you, just give us the 1-minute rundown on what you've done, and also how many deeds have you been responsible for?
Yeah, so I mean, I talked about yesterday that I was.
But you don't look that old to me.
Oh, thanks for that. It's very good. Must be my skin regime. I don't know, or I don't know what it is. Yeah. So look, you heard me talk yesterday when I was at KPMG doing large, super big deeds for managed funds, etc. With the SMSF, one of the areas there is I was actually involved in making submissions on the Superannuation Industry Supervision Act. And the only reason that was ever put in place is because OSSA, which is the Occupational Superannuation Standards Act, was effectively about to be held to be unconstitutional because there's not a framework of power for the federal government to make laws in relation to superannuation, because obviously it was framed back in 1900. So I made a number of submissions on that. I was right at the forefront, listened to all the people drafting it, etc. Since that period of time, I have basically written 4 SMSF deeds. One of them is still at now infinity. Reckon my 2000 deed was there. I always look at every few years rewriting and rebuilding the SMSF deed from the ground up. Just simply strategies, technology, cases and rulings really requires that, whereas you find that most other deeds have been around 20 or 30 years and you keep on, it just patchwork up. And if you can't read the deed or understand it, then I think we all really know that we're sort of back foot. So the deed that you're using now, like your docs, was one I wrote in 2016 and updated in 17. Made a few changes recently. It's got the 6-member fund. You can run sub funds. There's a lot of stuff there. So, yeah, I know my SMSF well. Love all that estate planning and that, but yeah, SMSF's my real wheelhouse.
What I'd like to do, Grant, is put a document together with you on all the key changes in the last 10 years and what needs to be in a modern deed, because I think there's so many deeds out there that aren't modern, and just so we can help accountants to understand the changes needed. And we will write some Change GPS VPP marketing material, value plan price, so we can help accountants for you to explain this to your clients and why they should pay you $500 or $750 or whatever you want to charge to upgrade their deeds. So
yeah, it's funny. I only just came across one yesterday. It was someone who the deed was from 2002, and they were running an account-based pension through the deed. Now, the deed didn't allow that because account-based pensions weren't available until 2007. So in those days, even then, the early and nascent pensions that were allowed were just starting then allocated pensions. So effectively writing a pension after that, and I want to come back when we have a look at the laws a little bit later on, the accountant and the auditor had signed off for many years that the pension documentation or the account-based pension documentation was compliant when it wasn't, because it was in breach of the governing rules. But we'll have a look at that a little bit later on.
Definitely. Now, this is a very good slide to start with, because when I say at the beginning of this presentation, because so many accountants think that we cannot talk about SMSFs. So many accountants think that we can't set them up. And look, if you're an accountant that is registered as is authorised representative of a dealer group, yes, I understand that they will make you do a fully fledged statement of advice and go through the process. But if you're an accountant that is not an authorised representative of a licensed financial dealer group, you've been making, over the last year or so, accountants very aware that they can do things in certain circumstances. would you like to briefly tell accountants what they actually can do?
Yeah, so I was involved right at the first start when they did the Financial Service Reform Act in 2003, 2004, which essentially brought into account financial planners. And for some strange reason, SMSFs found their way in there by way of the fact that if you're dealing with a superannuation interest, that's classified as a financial product, such as a contribution, a pension, all of those sort of things. At that time, they then had the accountant's exemption, which dropped off a couple of years ago. But this is one that came out in 2018, and I'd implore everyone actually who's particularly limited license accountants, given the fact that fees are going up all the time and will continue to do so, to have a really good read of this ASIC Info 216. You can see there's a couple of regulations which are still built into the Corporations Act. Go and read those too if you want. But essentially, you can give advice to a client on establishing and operating a SMSF. Importantly, from that perspective, you can discuss the different styles of SMSF, such as a multi-member, or you'll see tomorrow, I think we're talking about bloodline SMSFs. And essentially, if we're going to do that, what we'll be doing there is talk about different structures. Now, importantly, when you do that, and we've built this into our system, you'll find that when you establish an SMSF, whether it's with a corporate trustee or an individual trustee, you can tick a little box and essentially a letter pops out from you to the client stating that you're not licensed, that effectively under Regulation 7.1.295, you are required to tell them that the advice is solely to ensure compliance, and more importantly, they should go and seek financial planning advice. Whether you don't have to force them, but you simply tell them to do that. The second one is around investment strategies. Most people probably aren't aware that when you're dealing with contributions, you're dealing with pensions, you're dealing with a member's interest. And essentially in the Corps Act, in Part 7, that's looking at consumer protection. So when you're dealing with investment strategies, you're dealing with the trustee, not the members. So therefore, really, all accountants are able to, particularly tax agents, are able to provide an investment strategy. So it's not in breach of the law. But as you can see there, the only time it will be in breach is when effectively you start to recommend specific investments. You can, believe it or not only do benchmarks in terms of investment strategies, draft one up, but you can even recommend what asset allocation you would do. But I wouldn't be doing that. It just shows you the extent that many of us probably aren't aware what we can do as an accountant or a tax agent.
So look, that's a great way to really kick things off. Make certain you look at that ASIC info sheet, look at those key things that you are allowed to do. Now, again, if you've got any concerns, or if you feel, look, I haven't done this before, I want to double check it, contact Grant and the team at Lightyear Docs, and they'll be able to assist you with this. And you'll see as we go through this that everything that Grant talks about goes straight back to the legislation or the ASIC releases. There's a lot of fear mongering in our industry. People say, you can't do this, you can't do this. If the legislation allows you to do it, you can do it. That's why it's there. And that's what being a good advisor is, to look at what's possible and then adapt it to your client's circumstances. So what's this information about small super, Grant?
Yeah, so essentially when we had a look in 1994, the government came up with this concept of small super or excluded funds that had 4 members or less. In those days, the members didn't have to be trustees. So essentially we started off that, and there was a lot of fun times in those days where you just buy computer equipment, lease them back to your office, and you buy abalone licenses. So they were the good old days that accountants used to love. But essentially a self-managed super fund or a small super fund is one that's got 4 members or less, and that's about to jump up to 6 members. It has to be a superannuation retirement fund. It can be a trust structure, but I have seen, believe it or not, a company structure for these as well. If it wasn't held to be a complying fund, and I'm going to talk about this a little bit later on. So if the fund is not a regulated fund under the SIS Act, then effectively it's just a non-distributing fixed trust. And so therefore all the income that's kept up in would be taxed at the top marginal rate. And you can go down there, you can see gnarly income is also taxed at the top marginal rate. If you've got a foreign SMSF, so that is, central management control of the SMSF is outside Australia, income and capital gains are taxed at 45, as is non-complying. accumulation side is 15 and then 0 for pensions. So we've actually got a pretty big swathe of different taxes there. Some of the small super fund problems that you find is when you look at trusteeship. I know a lot of people like individual trustees. The only problem is they might have been okay when you're first starting the fund, when you say 35, 40. But the problem is when you want to obtain anything from the fund, you can't pay, if you're an individual, you can only pay an old age pension. So that's, again, going back to the constitutional law. Remember I said the OSA was held to be essentially unconstitutional. So the government had to have two heads of power in order to latch it on and make it viable in terms of the constitutionality of the SIS Act. One was the corporate trustee. So if you're corporate, you can do basically anything. Whereas if you are an individual, you have to pay old age pensions. So it means in that deed, you can't offer a transition to retirement income stream. You can't take lump sums. The only way you can take a lump sum is to set up a pension and then effectively commute it. So as an advisor, if anyone is down in that stage where they're seeking to take a benefit or an income stream benefit or a lump sum, if you want to take a lump sum, you must make sure you upgrade to a corporate trustee. The other one is with the corporate trustee, we're going to have a look at a bit of a couple of case studies. I just want to run you through some from a practical guidance point of view. And of course, these are really crucial. But when we have a look at the corporate trustee, who are the directors and really who owns the shares? And I want to look at the definition of Section 17A, which is definition of SMSF. You can have a small APRA fund, but we won't really talk about that today. So what I've got here is just one. This is a good one for you, Tim, and we'll have a look at it. So John Smith's the sole director of the Smith SMSF and owns all the shares in the company. He's admitted to a hospital with terminal cancer. He's in a coma. His family needs to pay for his care from your super fund. How do you go about doing that? What's the issues there?
Oh, number one, sole director.
He's in a coma.
He's in a coma. That's the big issue. Yeah.
Yeah. So
lots of issues. It goes back to control points again. Like it's looking at any situation. Where's the control point? And it's passing on of control point to another person, isn't it?
Exactly. Yeah. So succession there. So here we've got no one. He's got no succession. Essentially, there we've got the shares. Even if he's got an enduring, so that if you have an enduring power of attorney, you may not be aware, but the enduring power of attorney covers you from the relevant state-based legislation, like the Powers of Attorney Act, etc. So what happens there is because they're state-based, they can't make you a director because that's obviously company-based legislation, which is federal. So we need to go inside the Corps Act and work out exactly what's going to happen. So if he's the sole shareholder or he's the sole director and he goes into a coma, then you're in a very invidious position there because no one can take over. There is no succession. And as a consequence of that, you're going to have to go to the Supreme Court and try to get someone appointed as effectively as trustee, which may end up being the public trustee. And as soon as you do that, you might as well just wash 15 to 20 grand down the toilet in terms of their fees as well. So again, this is just a simple one, but there's so many of you, particularly we've got mum and dad funds, and then you've got, dad's gone and mum's left as the sole director. You just got to be really careful about that because if suddenly they go into a coma, that whole thing freezes up. And you know what happens if you've got, for example, the payments that need to be made. Who can actually make a payment? I mean, with the accountant, you can't go in and make a payment because otherwise that's theft.
That's fraud.
So no, if you have a look at it, there's the banks, unless they get an EPOA, have a look at the trust deed, and it's not a pretty sight. They've got to show that it all links in, and as a consequence of that, if it doesn't, then basically no one can make any payments whatsoever. It's the same thing. Even
massive issue.
Even if he dies, what are you going to do there? You can't do anything. The shares may go to the executor, but the executor can't deal with anything until probate, which could be like 6 to 12 months. If the will is challenged, it could be 2 to 3 years before you can do anything there, simply because the person who set the fund up, which is generally the accountant, hasn't thought about that succession planning that you talk about.
So just a couple of quick responses to questions. Paul Hopkins, we're going to talk on Friday about the change to AASB 20-02 because there's a lot of conjecture out there about whether we have to have deeds changed before 1st of July 2021 to remove the financial statements prepared in accordance with Australian accounting standards. Now, there's a lot of differences of opinion on that. We're trying to get a high-level sign-off by the IPA, Institute of Public Accountants, on that, and we're getting BGL's and Seamless SMSF's viewpoint as well. So we're going to cover that on Friday. Someone asked, are we covered? If we're covered by an AFSL, can you still rely on ASIC Info 216? You need to talk to your dealer group, but definitely not.
Yeah, no. So actually, you'll find. Look, I'd implore everyone to read Info 216. So don't even think about it from my perspective, because they actually go through and give examples for a tax agent. This is exactly what you can talk to your client about companies. This is what you can do about pensions. This is what you can do about investment strategies. So, I mean, they're the regulators. So as long as you stick within their tram lines, then you're A-OK. So I've seen a number of people who have read that and then they've gone and given up their limited license. The reverse side is if you have license, if you've got a license, then you'll see embedded within Info 216 is that you can't use the exemptions within 216. So have a really good read. It's not long. It only goes for 2 pages. Do your Google, and yeah, I think it's as a fundamental building block for those of us doing SMSFs. I think it's really the way to go.
Excellent. So
some more problems on from John Smith. Remember, he's in a coma, sole director. He dies. What happens? Well, we're stuffed there. And we're going to come up with some solutions on this. There's some simple, and then there's some more sophisticated ones. He's had $500,000 in his estate to his 2 children, not his current wife, who makes a family provisions claim, which is obvious. But the first thing there is that if she's making a family provisions claim, if I was her lawyer, I'd be latching onto those shares. So I'd be just saying, you can't do anything with those shares. You can't make a director. You can't do anything. Because while I've got that, I'm freezing up that fund. And I would do exactly the same thing. We talked about this yesterday with the Successor Director solution, the family trust. I'm going to freeze them up because I know you're going to have payment problems on the other side. Suppliers are going to get pissed off. The banks are going to get upset. So when we come to the negotiation table, you're going to be willing to do anything that's possible to get a deal there. So even though your superannuation generally sits outside family provisions claims, that's the way that I would get it in. If there's no BDBN...
Just from an accountant's point of view, listening in, this is gold, hearing this, because, and you'll hear more of it Thursday with the other lawyers coming on board, to learn how would you attack a situation and how would you defend a situation. Because don't forget, we're talking about our clients, but how many accountants here have you got your own self-managed super fund? Think about your own personal circumstances. What would happen if John is you? You know, how are things going to work out for your family? So think about all the defences you can put in place to make certain things will work out right. Do this for yourself. Run through this process for you and your family. Then you can start offering it out to clients. Sorry, Grant.
Yeah, no, it's perfect. So if he's got no BDBN, then essentially you'll generally find you have to go and have a look at what the trust deed says, the governing rules. But quite often it will say that, you know, it's trustee discretion. So we all want to become a trustee because then we can distribute it basically to wherever we want. So again, we've got to have that. So as I said, all of that, it's Supreme Court stuff. You're looking at $150,000 to $200,000 just to get it to a reasonable resolution. So the easy way to do it really is to have what we call a successor director. So with your corporate trustee in this place, you just need to upgrade the corporate trustee and then put in place a binding resolution. You don't need to notify ASIC at this stage because it's contingent upon death, disability in this instance, or simply that the client wants to resign. They don't want to take on the responsibility as trustee anymore. So in that instance, we can have a successor director, and I'll talk a bit more about it, who comes in and runs effectively the show. For an SMSF, the successor director is going to need to be either your enduring power of attorney while you're alive, or your executor when you are dead. So either one, just make sure you've got that in place, and that solves the problem. Around the
just to clarify that, the successor director documents are available on Lightyear Docs.
Yeah.
So I think they're $99 per set, and includes a constitution upgrade if needed and the resolutions.
Yeah.
And someone asked as well about SMSF investment strategies. They're available on Lightyear Docs as well. So Grant's only one that I've seen with the Successor Director solution. I haven't seen those documents available anywhere else. And this started when we were talking back in COVID, March last year, and we both kind of thought, holy crap, like if someone's incapacitated, what happens? How can you lodge a Form 484 with ASIC to change the director?
I know
you can't just do it. A lot of accountants will just go and do it, but that's fraud. You can't do that. You actually have to have a resolution that ties back to your constitution that allows this to happen. Then the successor director can sign the Form 484 and jump in play.
Successor director. Case just recently where an accountant got pinged for backdating and signing a document. So you just got to be really careful on that one.
The successor director is something that's actually not, of all of these sort of new things to do, the successor director is not the hardest thing to educate your clients on. GPS members obviously have access to a ton of client emails to educate your clients. But what a lot of practices are doing that I talk to, they're having successor director conversations at the time the ASIC annual renewal's due. Because what's happening is the client's got this ASIC government formal looking document in their hands. You can talk to them about only having one director and they're alert. They're very, very, it's painfully aware they're the only person on that sheet. So it's a great time to get involved. And I think that's the best time of the year to talk to your clients about this.
Absolutely. And this, you'll find with our successor director solution, but ASIC has got a guidance note 73, which basically says anyone who's got a sole director in a company, you've stuffed. And so, do you mean it's just
show the client that ASIC document? Hey, just can you say what one that is again, Grant? So
it's ASIC. It's public guidance number 73. So I think it's PGR, public guidance ruling 73. So again, what my preference is in my early days in SMSFs and everything, you'd always get into a shouting match. So this lawyer says that lawyer says this, Grant says this, Dan Butler says that. So we're lucky now, we're 20 years down the track that you don't need to, because you just say, well, it's got nothing to do with me. This is what ASIC says. This is what the tax office says. This is what the courts say. So once you do that, it's really, I've seen ones where, for example, you'll see with SMSFs, what is business real property? You might have, for example, 5, 6, 7 rental properties for a client, and they can be treated as business real property, which can be transferred into an SMSF, which is going to be a big saving, particularly if they're tax positive. You say, well, hold on, how can you do that? Because there's a tax office ruling on it. So again, what we need to do is really be mindful, and that's what I do, spend a lot of time on those private binding rulings. I know you drag a lot to my attention, as everyone else does. So
we've got some fun ones coming up in the next 6 months, I reckon, Grant.
Absolutely. In fact, I just built one the other day with a family protection trust holding the property and then doing a 50-year lease with a surrender value as well. So outside, so it retains its CGT principal place of residence exemptions.
Well, you're letting the cat out of the bag there for one of them.
I know. Anyway, let's just have a look at what SMSF is, because I'm fairly mindful of the time. But I think we all know we've all been hoodwinked. So members of trustees or directors of the corporate trustee. Yep. Trustees or directors of the corporate trustee are also members. I think we understand that one. No employee members unless they are related. No remuneration for acting as a trustee, but you can charge if you're a professional. For example, if you're an accountant, whatever. So over the page, now these are the big ones. Okay, so
I love these. These are great, yeah.
I know. So we know that. So that's the law. We're about to jump to a 6-member fund. So we've got a 16-year-old becoming a member of the fund to house their SGC and super contribution deductions against trust income. So they're taking up our advice. You're distributing trust income to them. They're actually employed by the trust, or they're going to just do salary sacrifice. So they're members of the fund. In fact, you're allowed to be a member of the fund from the time your heartbeat. A number of the old deeds, and that you can tell whether you've got a good deed or not just by having a look at who's a member. A number of the old deeds, you actually had to be in a position of being an employee, which is just crazy.
Yeah.
But in this one, when we have a look at it, who's actually going to be the trustee on their behalf, and we're going to have a look at the rules in relation to that. We've got a child who's got a severe disability, just been awarded $6 million from a personal injury claim. You've got 90 days. If you put that 90 days in, 90 days into a self-managed super fund, that $6 million that goes in is not tested as a non-concessional. Effectively, you can go in there. You can then pay a pension or an income stream for that child for the rest of their life. So if you have a look at that, and that whole $6 million effectively is going to be their non-concessional component. So if you start that straight away, then you're going to be in a really good position of obviously hiding a lot of that income. So that's a pretty good one. And if they're young, you also find that a lot of the income coming out is tax-free. But I still go back to the question, it's a great strategy, love the strategy, but who's actually going to be in there as their trustee or their guardian? A couple have got, they've got an SMSF here, they want to go back to Rhodes or somewhere to live for the rest of their life. They've got their SMSF, their accountant has told them they have to wind it up because they're going to go and live overseas, and they're worried about that for tax perspective. But, is there another way around that? Finally, Dad, we've all seen clients like that. He wants his wife and children in the SMSF and holds farmland, but he wants to have full control so they can come in, but they're not allowed to have any control whatsoever. So I'm sure you've seen a lot of clients like that, and many. So we need to, these are all sort of things that are real life issues. And if we go back and look, that earlier slide where we had member trustees, we're virtually stuffed because we can't do anything. So what we do is we focus in on the law, and the law is always about exceptions to the rules. So Section 17A, there's 3 sections here, and I'll just cover them separately. So the first one is A. So you're still at SMSF, even though you've got another person acting as trustee on behalf of a member. Firstly, the member of the fund has died, and the legal personal representative of the member, that's the executor, is a trustee of the fund or director of body corporate, the trustee of the fund from the time the member died and when their death benefits commenced to be payable. So if we go back to that John Smith case, if we've got that successor director, and in that successor director, our executor is appointed as successor director, then we're right on the money. Does everyone follow that one? So what happens if John dies? Well, it doesn't matter. We appoint the successor director. We've got the 484. The documentation's already done. He comes in. So then we've got the BDBN. The good thing about it is if he's the executor as well, and he sees a family provisions claim being made by the current wife, then you're not going to transfer the $1 million of super over to the estate. What you're going to do is say, well, shut up, I'll give you $100,000, provided you don't make a claim on the estate. And then what he does is he makes that $1 million payment directly down to the 2 children. And with those 2 children, effectively, it's outside of family provisions claim. And that's simply because we've put in place a successor director. Does that follow? So we're probably just $100,000 legal fees from that. Likewise, so that's on the death scenario. The second one, which is really important, covers a lot of the issue. The legal personal representative of a member of the fund is a trustee of the fund or director of the body corporate as the trustee of the fund in place of the member. During any period when the member of the fund is under a legal disability, 1, so that could be our disabled child. Everyone remember that one? So we've got a disabled child, whoever's their legal personal representative, such as their parent or guardian, they can take their place. So what they do is they're the replacement trustee or replacement director on behalf of that member. So that member who's still alive, still a member of the fund, doesn't have to be a trustee because someone else can take their place. And why is that? Because 3B1 authorises it. Or 2, and this is a big catch-all, the legal personal representative has an enduring power of attorney in respect of the member of the fund. So if we go back, if you just want to go back to the earlier slide as well, that I had a look. So we've got the couple in Greece with $2 million going home to live in Greece. So all they have to do is they keep the fund here. And this is how it works. The enduring power of attorney would run the fund here. They can still be members of the fund. They would receive an income stream from Australia. And effectively, it's not taxed in Australia because of the Australia-Greece double tax treaty. And it depends on some jurisdictions, it's also not taxed over there. So the advice they received from the accountant to wind it up and put the money over to Greece is just a crazy situation because it's going to cost them a lot. Same one now. This is an interesting one. A dad who wants his wife and children, his SMSF, that holds their farmland, but wants to be in full control. Well, there you go. So all dad has to do is, if the children are under 18, you'll see in the next situation that parents or guardians can be their replacement trustee or director. Alternatively, in this one, he'd have his wife's enduring power of attorney. So again, if you just go to the legislation there, so you'll see under subsection B, 2, that if he's got his wife's enduring power of attorney, right at this present point in time, you can do a 484, resign her as a director, and then he becomes a director. And then, of course, if they're adult children, do exactly the same. He has their enduring power of attorney, and you'll see built within our enduring powers of attorney at Light Year Docs, you tick a box and you're actually electing there that your enduring power of attorney is going to be your superannuation trustee or a replacement trustee, which is needed now to be specific. You can't just simply put in there to look after your financial affairs for the case of G&G. In C, which is important, if a member of the fund is under legal disability because of age, so they're under 18, and does not have a legal personal representative, the parent or guardian of the member is the trustee of the fund in place of the member. So we could have dad with 2 kids and wife with the EPOA, so we can have one director corporate trustee or one trustee who's then looking after all the members. So again, I would counsel for many of you having clients of elder years, it's probably, again, we want to have that succession, but it's probably worse having them as trustee or director of the corporate trustee because their mental acuity, etc., is just not up to the scratch. So bring in someone younger or someone else just to simply take their role as the enduring power of attorney, hence the replacement trustee.
That is fantastic. Look, that is a massive takeout to everyone here today, just to be able to examine those situations, thinking about every one of your clients with SMSFs and looking at different people that could be directors of the trustee company in those positions of control. I reckon, Grant, that's just brilliant. Now, what is this about? How are we breaking SMSF laws every day? I read this, like, whoa.
I know, it's crazy, isn't it? Because if you see there, we start with section 10.1 of CISA, and basically the governing rules in relation to our SMSF are any rules contained in the trust instrument. So that's the whole deed. Any other document or legislation or combination of them governing the establishment of the operation of the fund. So it's the deed, it's your pension documents, it's your SMSF Will, your BDBN, your investment strategy, LRBA documents, contributions and suspense accounts. So an auditor really should be checking every transaction as against the deed and the governing rules to make sure it's allowed. Because if it's breached, then what happens is we go to 54C, which again, if we know our way, our jigsaw way through, it's not so complex, we can find our way. So logic says we find out what the governing rules are. So that's all the documentation that we are using. 54C says 1, a person, and a person means an auditor, an accountant, a financial planner, a trustee, a member, if we go back.
Gone the wrong way, there we go, sir.
Okay, yeah. A person must not contravene any other covenant, which is just simply a rule, contained or taken to be contained in the governing rules of a superannuity. So if you breach, for example, remember I talked about the people that set up the account-based pension when the deed only allowed an allocated pension, boom, that's it, they're gone. They've actually broken the law, because under 54C, all of these governing rules are actually become an extension of the law. Does that make sense? Because it means you can't breach those. And it's interesting, if you do it willfully and make a profit on it, then you are also have breached section 202, which also means you've potentially breached the Commonwealth Crimes Act. And there's no PI cover for that one. That's why you need a really good solid deed all across your whole range of clients, with the documentation flowing into there, just so that you're really comfortable that the whole system works. And the system we're talking about is the governing rules system, because we're making law on the fly. Now, the danger we've got is 55, which basically says, subject to subsection 4A, a person who suffers loss or damage as a result of conduct of another person that was engaged in contravention may recover the amount of any loss or damage by action against that other person or against any person involved in contravention.
Boom! That is massive.
I use this all the time when we see at Abbott-Family clients have come in and said, oh, and I have a look at what their accountant's done, and it's cost them quite a bit. So all we do is just simply write to the accountant and say, well, bang, this is what's happened. You've contravened the deed, and as a consequence of contravening the deed, we're then going to recover any losses or damages, which is important. And if they've charged fees for it, then we can even get a bit nastier and refer it to the ATO for potentially criminal action. So it depends.
That's obviously if the accountant was a lazy or a dodgy one that just did not do the right thing.
Exactly. So definitely that's where the early release comes in. So all the people who've done early release, that's exactly how the commissioner attacks it. But it means that you probably won't be this extent, but it really means that all the documents we do really have the force of law, which I really love about that.
Brilliant. So we've got one more slide with Grant, and then we'll keep Grant on, and Frank from Seamless will come on and join us here. So
again,
what are some must-haves?
Yeah, so what I want is when I have the must-haves in my governing rules, which is my trustee, I want to see a contribution suspense account. So that's the contributions. So what I want to see that's done, and then secondly, I want to build a set of documents that evidences that flows out of the trustee. Now, once I build and execute those, they are also part of the governing rules. And again, anyone who breaches those, effectively, you've got a position thereby that they've breached the governing laws. Because I have seen some instances where you put that in and an auditor has tried to knock it back. And I've just said, you sure you want to knock that back? Because if the fund goes non-compliant because of this, and it's held that it was complying, then what we're going to do is we're then going to sue you for loss or damages, because what you've done is you've erred incorrectly against the governing rules. Anyway, that's how that plays. Successor Director, absolutely crucial. We're going to talk about leading member funds, I think, tomorrow, which is a stronger version of Successor Director, my preference, because it actually turns the fund into a bloodline fund. Reversionary pensions, so again, the governing rules flow on, and it's so much better than a family provisions claim. So if you've got a pension, it goes from, say, yourself, then to your spouse. It can then go down to any financial dependent, unless it's a child. So it can go to grandchildren, can go to whoever you want. So that can continue on down the track, and it sits outside family provision. Dependency declarations, family allowances, we talked about that before, but if we've got that ongoing monthly stipend going to a family, potentially that whole family, including the children, are financially dependent. So again,
I've been doing that for a number of my clients, where the kids are, in their 20s. Mum and dad are paying for things. So I've used what you've got on 9-year docs, the family allowance agreements and the dependency declarations, and clients love it.
Yeah, you'll actually find there's quite a bit of diatribe in those family allowance agreements, particularly some private binding rulings. So it's better to have it in place and try it than not have it in place anyway. Investment strategies, I prefer to see them commencing on the 1st of July. So if you're on our system, what you'll do is you'll have one for last year, then just jump on, just redate it 1st of July, because an investment strategy is a forward-looking document, which I'm always concerned when auditors sign off an investment strategy, which is probably, 16, 17 months after year end. The strategy is not looking back, it's actually looking forward. SMSF Will is just a set of binding death benefit nominations. A lot of people will have a BDBN that's tied in with the SIS Act. Unfortunately, the SIS Act BDBN rules don't apply to SMSFs. So it really comes back to what sits in your deed. And in your deed, you've got a lot of directions. Now, the important thing about that is an SMSF will is just nomenclature around a set of binding death benefit directions. It's just easy to talk to a client, well, I'm going to make a will around all your SMSF benefits, because I want to keep those benefits outside of your will. I want them to understand that this is quite separate from your will. And as a consequence of that, we can then create, for example, an SMSF testamentary trust, not an estate testamentary trust, using the money from super, let's say for that adult child who's getting the lump sum, and actually putting that into a testamentary trust settled by the executor or the trustee or someone who's obviously not going to partake of it. And then you're off and running and still getting all the concessions for adult children who are under the age of 18. So they're the sort of things that's what I would want to see all of those strategies, modern strategies inside a deed. Things like tresses and stuff like that are pretty boring. The only other one I was thinking today is probably temporary incapacity, where someone just gets sick, you can actually access monies from your super. So I'd like to see that in there as well. So there's some of the must-haves. And again, if anyone wants to go through, wants to see something, I can show it on the deed and can have a look through there. I've made the deed very easy to read, and it keeps on getting easier all the time, but basically it covers everything.
Great, that is sensational. Look, that's something you'd spend a week talking about, but you've compressed it in about 35 minutes for us. So thank you for that. That's great. What we're going to do is on Friday, we're going to be looking at how you can upgrade your deeds, how you can use the Change GPS, Value Plan Price, VPP email to help the clients to love and understand the value you bring to the table to fix up these situations and how you can price for it, and how you can use BGL software to maintain a proper register of all of your super fund and trust deeds and constitutions, and then you can look at how you can upgrade them all. Now, we've said a number of times, and I'm going through this process as well, we've brought on board large numbers of clients over the last couple of years, and the deeds all over the shop. I'm upgrading every deed to, I'm using Lightyear Docs, to the Lightyear Docs version. So we've got the same version for every client. And I'm going to put together an email for GPS members as well for investment strategies to get your SMSF investment strategy done as at 1st of July. We'll charge $350 per strategy plus GST, roll it out for our super funds. There's some good billings in July and the clients are covered.
Exactly.
So absolutely brilliant. Grant, please stay on. What we're going to do now is we're going to invite Frank Spader from Seamless SMSF. Frank, are you there with us? Please turn your video on. How are you?
Hello, I am here. How are you guys?
Great to see you. Now, Frank, what is your role at Seamless SMSF?
I am the head of technical and training at Seamless SMSF. Very fortunate to be the first ever employee when we first got things started. So I've been with Mike since the very beginning, and it's been a fantastic ride so far.
Brilliant. And you would have enjoyed this half an hour last lot of technical stuff we've been going through with Grant?
Been fantastic. And it actually does lead into the, I guess, what we're going to speak about. As auditors, we're often seeing the problems, the after the fact issues that could have been resolved if things and strategies and processes had been put in place. So what we're going to go through today are the 7 most common issues we see with trust deeds when auditing a fund.
Brilliant. Now, the first one you've got here, principal employer deeds. What are they?
So for some, what we would call legacy deeds, they have these principal employer sponsors. Essentially, that is where an employer is a party to the deed, which sounds fine. However, what we might find sometimes is there's clauses within these deeds that state where this principal employer ceases to exist, the fund must be wound up. Obviously, that's going to cause problems for your fund if it's going to be forced to wind up. A very common way to fix this would be actually reviewing your deed, having it updated and removing these clauses altogether, because it just removes that risk you have in the future of those employers being, ceased.
Excellent. Now, the second one is one that we hear all the time. Clients have lost their deeds, can't find it. You're an accountant, you take over this client with this super fund and there's no deed. What do we do?
Well, this is a real funny one. So fund comes through to audit. We're looking through the fund, trying to, make sure everything's there. And we ask for a copy of the trust deed, and the accountant says, oh, well, I don't have one. I only just recently picked this fund up from an accountant, and we don't have one. And that's going to cause you some massive problems. So what we would, again, recommend is if you don't have the deed or you're missing documents, well, you need to adopt a deed. That every fund requires a deed, and maybe that's where you can go to speak to Grant, and Grant can help fix this problem, because you're going to need a deed before sign off occurs.
I think that's pretty important, because if you don't have a deed,
what do you got?
You haven't got governing rules, and it's very hard actually to prove that right at the outset that you're a superannuation retirement fund, because you may well just be that fixed trust. So with the lots deed, there's two ways of doing it. One is to go to the Supreme Court, so it's going to cost you a lot. Alternatively, the tax office did come up with a process around about a decade ago, which we still use at Abbott-Family, and it's like a stat dec, except you're doing it through a deed. As to the terms and provisions at the same time, then you can upgrade to a brand new deed. So if you do come across lost deeds, lost constitutions, or lost discretionary trust deeds, it's really important to jump on them now and fix them up.
Brilliant. Okay, the third one, contribution reserves. I know we've been talking about that, Grant and I, on a lot of webinars recently. Frank, what do we need to do?
Well, this is obviously, it's a very popular strategy, provides fantastic tax benefits for the members. However, what sometimes is missed is that the deed actually doesn't allow for a contribution reserve to take place. So they've gone through all the effort to get all the documents prepared, all the reserving minutes, and making sure that everything's in line. However, the deed actually doesn't allow for that. So again, what this might mean is that when you're going through certain strategies or creating certain processes, that there is a step where you check your deed to see if it has those provisions, or if you're not sure, maybe that means again contacting Grant, updating your deed so that you don't actually even need to worry about having those checks in place.
Exactly.
Yeah, brilliant. The fourth one, different asset classes, and you've got the crypto word on there. Whew. That's the big buzz. Everyone's asking about that all the time.
That's right. Cryptocurrency has been a huge, asset class for super funds in the last couple of years. And as such, another thing, again, it refers back to checking your deed, is actually making sure that the deed allows for certain asset classes to be invested in. Some deeds, typically older type deeds, have restrictions on certain asset classes. So again, this can easily be resolved with making sure that your deed is up to date. If it's not, well then again, you might need to add in that process to check your deed to make sure that you're actually not going to run into that type of restriction.
Brilliant. Fifth one, the date of the SMSF deed. Why is this important?
Well, as everyone would be aware, legislation is constantly changing. There's been the introduction of account-based pensions, limited recourse, in-house assets. So as the legislation changes, your deed needs to be in line with that legislation. So for example, the two most common things we see with regards to this is that the deed doesn't allow for an account-based pension to commence because it's dated before the account-based pension rules exist. Or alternatively, with limited recourse borrowing, there's no provision for a limited recourse borrowing to take place. So, and you would think that this could, again, be easily resolved by continually making sure that your deed is up to date. But if you're not doing that and your deed isn't up to date, very regularly, you're going to have to check these provisions because there may be other ones that are restricted as well.
Yeah, brilliant. Now, stay tuned, everyone. We've got about 5 minutes to go, and we've got a special offer from Seamless SMSF for everyone in the audience, and another special one for GPS members as well. Okay, number 6, pension commencement.
So that falls in line almost with our previous point, and that again is in regards to making sure that your deed actually allows for a pension, an account-based pension, to take place. Generally, if the deed is dated before 1 July 2007, we know that's when account-based pensions were taking place and that legislation changed. You want to make sure that if your deed is dated before then, it allows for those provisions. Most likely it won't. So again, make sure you update your deed.
Brilliant. And the last one, Frank, death benefits. Similar sort of thing in a way, yeah.
Yes, that's right. So with estate planning taking place, BDBN, reversionary pensions, death benefit pensions, there's all these different estate planning strategies that you would be aware of that you're adopting with your clients. But what you've got to make sure of is, does your deed allow for those strategies to take place? Which one takes precedence out of a BDBN or a reversionary pension? Is a BDBN lapsing? Like making sure that you're actually across these things that you're putting in place, because again, like Grant said, the deed is the governing rules of the fund. That's your starting point. So if it's not up to date, again, you may run into some problems down the track.
Yeah, it really needs to be flexible. And I saw one of the questions there before. Someone said, should we put in the deed details around TPV calculations? Never. You never put any numbers, anything ever into a deed. Can you imagine if if I put into the deed that I'm only allowed to put in my contributions up to my age-based limit back from 2006. So it needs to be that's something that grows over time, and we don't put numbers in there. We don't put formulas in there. What you want to do is open it up and say, well, the trustee can do anything around pensions, multi-reversion pensions or whatever, subject to the superannuation rules. So what that means is you can do anything around that income stream side, but then it shrinks down. And then if the laws change, then it opens up. If it shrinks down, it's going to be on that continuous phase. So that it really does that. Like even in our deed, you've got an ability, and this is again subject to a case, that if you've got, for example, a pension and you've missed your minimum pension payments. So in our pension documentation, it's deemed to be a promissory note, which is paid out as a pension payment at 30 June. Again, you're just thinking about the top-up people can do, and you do that. The other one is you can tick a box, and that any amount over your minimum pension payment is treated as a commutation payment, which creates a debit in your TPB. So it's, again, just thinking these little things, and you should really just have to tick a box, make sure, obviously ours is all tied in with our deed, tick a little button, and then off you're running with a brand new, a really strategic set of documents, etc.
That's brilliant. And look, what I'm really, Frank, those 7 things, they're fantastic reminders for them. And there's a big takeout I have from this, again, that's why I love doing this, because it just, you get reminded of so many things. For all these accountants out there who are focusing on charging low prices for SMSF work, and for people charging low prices, $250 for an SMSF audit, I'm calling out, it's crap. You cannot go through and check off everything that you need to and do a compliant audit for $250. That's insane. You can't do it. And the same with SMSF accounting and admin work. All of these things you need to go through, compare the deeds, look at things, go back, make sure everything's documented. This is so important. And I just feel I'm scared that so many accountants, because on a race to the bottom, because they're too scared of quoting a proper price for their client to their clients, race to the bottom, and they're not getting things done properly. And I'm scared for accountants out there that there are a lot of issues that might be in your super fund or audit files because you haven't charged properly, and so therefore you can't spend the time required to do a quality job.
Yeah, just remember the old 54C and the 55.3. They're going to be able to recover loss and damages against you. The auditor, the accountant, the financial planner, they're going to go for everyone. And again, that's only a few of us who are using that, but I use it to, at Abbott-Family, we use it to great effect. But again, it's going to get more widespread.
I personally feel I can't see how you could do an audit for a self-managed fund for anything less than $1,000 to do a decent quality audit. And so this race to the bottom, I reckon we're going to see a lot of problems in the future. So just accountants, let's just have a think about that. There's just a little bit of an alert there that we can all take away. Really quickly, before we come with our special offer, tomorrow is going to be epic. The last 2 days we've covered a lot of theory. Tomorrow you are going to see how can you guarantee a line of succession for your super funds or trusts. You heard about keeping money in your family bloodline. Grant will show you the clauses in the deeds in light year docs tomorrow, and the way of succession is written, hard-coded in the deeds. So people cannot fight over this. Even blended families, avoiding family provisions claims. Tomorrow is going to be a cracker. And then we're going to finish off with trust distribution resolutions, the difference between trust income for tax purposes, getting the definitions right, and show you a new release and change GPS that will make it easy to get everything done by 30th of June 2021. So Dave, I'm really excited about tomorrow. This is a special offer. Seamless SMSF. Any audience member today, 10% off any trial SMSF funds before 30th of June. If you talk to them, GPS members, access to wholesale prices, contact Seamless SMSF, ask for Taryn, tell them you're part of GPS or you're a part of the audience today, and they will look after you.
Tim, chuck up the poll because this is a major announcement for us. Starting to work more closely with Frank and Taryn and the team at Seamless SMSF. a fantastic way to outsource your SMSF audits. We think it's really valuable for Change GPS members because they share the passion you have, Tim, for making sure that everyone charges the right amount for the work that needs to be done. Hey, everyone, if you want to get in touch with either Change GPS, Lightyear Docs, or Seamless SMSF, we've just put a poll up. Let us know and someone will get in touch and we'll be able to help you more. And really, this is all the CPD we're doing for you. Don't feel any pressure. If you don't want to sit in a demo from anyone, no worries. But if you do want to know more and find more ways to help your practice, all of us would absolutely love to help you. As Tim said, we've gone through the theory, but both Grant at Lightyear Docs and Frank at Seamless and myself and Tim and the team at Change GPS are here to help you. I thought today's session was absolutely amazing. I like talking, but I also know when to stop talking. And it's when Grant Abbott, Frank LaSpada, and Timothy Munro are talking about SMSF Deeds. You guys are absolute experts. That was absolutely brilliant. I've no doubt the crowd absolutely loved it. Tomorrow is going to be a massive day.
Yeah.
Huge promo, everyone. 10% off trial period when you jump onto Seamless SMSF is just absolutely massive. Thanks very much, Frank. We can't wait to work more with you and the team there. Guys, look, the comments are just going gangbusters at the moment with everyone. We're so glad that you loved it. We're doing this for you. You can hear the care that both Grant and Tim and Frank have about the accounting community getting this right. It is hard. It is really hard. It's hard to keep up to date, but we all appreciate the importance of accuracy here. Thank you very much for joining us, everyone. We're going to see you on day 3.
Day 3 tomorrow, Dave.
Deed Awareness Week.
Grant, look forward to seeing you tomorrow. Frank, we'll get you back involved with us very soon.